Chapter 3, Financial Statements, Cash Flow, and Taxes. So here's an overview of what we'll study in Chapter 4. Our major financial statements, the balance sheet, income statement, statement of stockholders' equity, the statement of cash flows, and then we will wrap up this chapter with a short discussion on taxes. Let's get started with the financial statements and the annual report. A firm's annual report is published one time a year. It provides details about the firm's performance and financial conditions. So the annual report is made up of these four statements. The balance sheet, which provides a snapshot of a firm's financial position at one point in time, whereas the income statement summarizes a firm's revenues and expenses over a given period of time. So if the balance sheet is a snapshot, the income statement would be a video. There's a start and an end. It is over a period of time. A firm's statement of cash flows reports the impact of a firm's activities on cash flows over a given period of time. And from our discussion in Chapter 1, we know how important cash flow is to a corporation. Cash flow is what affects stock price. The goal of financial management is to maximize the firm's stock price over the long run. And we also have the statement of stockholders' equity, and that's going to show how much of the firm's earnings were retained rather than paid out as dividends. So we're going to get started and in this short lecture discuss the balance. We will use a firm called DeLeon. It is from the Chapter 3 integrated case in our textbook. It's a snack food company that underwent major expansion in 2018. So we're going to be given the financial statements of DeLeon for 2018 and I believe 2019. So far, the expansion results have been quite unsatisfactory. They spent a great deal of money acquiring long-term assets in an effort to boost their financial position. Unfortunately, the company's cash position is weak, their suppliers are being paid late, and the bank has threatened to cut off credit. And the board of directors has ordered that changes must be made. So the managers of this firm have to make changes. Looking at the balance sheet, in general, we know that all balance sheets must adhere to the basic balance sheet identity. That is, assets equals liabilities plus equity or capital. Assets are what the firm owns, whereas liabilities are what the firm owes. Equity is the difference between what the firm owns and what it owes. Assets are made up of current assets and fixed assets. Liabilities are composed of current liabilities and long-term debt, whereas equity includes the firm's stock accounts and retained earnings. Let's look in general at the assets. Remember, this is what the firm owns. It is made up of current assets and fixed assets. Current assets include cash and equivalents, accounts receivables. If a firm has accounts receivables in its current assets, that must mean that it is offering short-term credit to its customers. And finally, the last current asset account is inventory. This could be made up of raw materials, work in progress, as well as finished goods. Net fixed assets, which is also known as net plant and equipment or net long-term assets, that's equal to gross fixed assets. That's the original price paid for those long-term assets minus accumulated depreciation. That is all of the depreciation taken on those fixed assets since acquisition. So we're finding net fixed assets. Note that the assets on a firm's balance sheet are listed in order of liquidity, with the most liquid coming first and the least liquid last. Total assets, again, is made up of all of our current assets plus our net fixed assets. Moving on to a firm's liabilities, remember, this is what the firm owes. Current liabilities include accounts payable. If a firm has accounts payable on its balance sheet, that means that its suppliers are providing the firm with short-term credit. Accruals, another of our current liabilities, this is an account for which services were already provided to the firm but not yet paid. A good example of that would be accrued wages, where employees had already performed for the firm, but they had yet to be paid. And finally, we have notes payable. This is a short-term liability. In other words, the firm has borrowed short-term and there is an interest rate attached to it. Long-term debt is a long-term liability. This is a debt for which payment is not due in the current year, and it would include things such as if the firm had issued bonds, or perhaps it had taken out a long-term loan, like a real estate loan, from a lending institution. Total liabilities is equal to all of our current liabilities plus the sum of our long-term debt. And finally, equity is the difference between assets and liabilities. This would include, for a corporation, its common stock, and we know that all corporations issue common stock. Some firms have a par value attached to their common stock. If that is the case, then there would be an accompanying entry called paid-in capital. Some firms have multiple common stock classes. All of these would be listed in that firm's equity portion of their balance sheet. Some firms also issue preferred stock. If that is the case, an entry would be made in the equity portion of their balance sheet. And finally, we have retained earnings. Retained earnings are just that. The firm has retained its own earnings in anticipation of investing in some project that would produce cash flows over an extended period of time. So here is the asset portion of DeLeon's balance sheet, 2018-2019. Just by eyeballing it, I see that the cash account has dropped substantially. Their accounts receivable, the amount that they've offered in short-term credit to their customers, has almost doubled. Their inventories have also increased substantially, as have their net fixed assets. So their total asset figure has just about doubled. Here are the liabilities and equity sections of DeLeon's balance sheet. We see that all of their current liabilities have increased substantially, as have their long-term debt. When we look at the equity portion, the common stock account stayed the same. So that tells me that they did not issue any more common stock. It also tells me that their common stock does not have a par value because there is no accompanying paid in capital account. DeLeon does not issue preferred stock because there is not an entry. Their retained earnings has decreased by quite a bit. So when we add together all of the liabilities and the equity portion, we come up with our total liabilities and equity, and this should allow us to balance our balance sheet. Assets equals liabilities plus equity. So we're going to wrap up this short lecture with this example problem. What I want you to do is to look at, in our textbook, problem 3.1 and try to work it on your own. After that, refer to the video reviews in Cengage, MindTap, and watch the short video. It will walk you through problem 3.1 and you'll be able to see if you got the correct answer.